Picture this. You're sitting there, staring at your screen. Maybe it's your phone. Maybe it's your laptop. Maybe you told yourself you were just going to check the market real quick. And there it is. That trade, the one you were watching, the one you almost took earlier, it's up. Not a little bit either. It's up enough that your stomach does that weird flip thing, and instantly your brain goes, wow, I knew it. I should have trusted myself. And now you feel late. You feel pressure. You feel like if you don't act right now, you're going to miss out again. So you buy. And for about 10 minutes, maybe an hour, you feel like a genius. And then it pulls back. And suddenly that same gut feeling that told you to buy is now screaming at you to get out. And you sell. And then, of course, because markets are cruel like that, it turns around again. And later that night, you're lying in bed replaying the whole thing thinking, why do I always do this? Why can't I just trust my instincts? Or maybe, why do I keep trusting them? If that sounds familiar, yeah, you're not broken. You're human. And that exact experience is the reason we need to talk about intuition in trading. Because here's the uncomfortable truth that nobody likes to say out loud. Your gut feeling's smart. It feels protective. It feels experienced. But in trading, most of the time, it's lying to you. And not in a small way, in a way that quietly drains your account over years while making you feel like you're constantly this close to figuring it out. My name is Linda, and I spend way too much time thinking about financial psychology. If you're someone who found it difficult financially, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Now look, I want to be really clear about something before we go any further. This is not a video about ignoring emotions or becoming some kind of robotic trader who doesn't feel anything. That's not realistic, and honestly, it's not even desirable. Emotions are part of being human. The problem isn't that you have intuition. The problem is that you've been taught to treat intuition like it's a reliable signal in an environment where it absolutely is not. Here's the thing. Intuition evolved to help us survive. It evolved to help us make fast decisions with limited information in dangerous situations. If you hear a noise behind you in a dark alley and your gut says something's wrong, you don't stop to run a spreadsheet. You move. And that's a good thing. But markets are not dark alleys. They are probabilistic systems. They are slow, statistical, and completely indifferent to your feelings. And when you bring a survival-based instinct into a probability-based environment, weird stuff happens. This is where most people get tripped up. They hear successful traders talk about intuition, and they assume that means I should just follow my feelings more. But that's not what expert intuition actually is. Expert intuition is built on thousands of repetitions, deep pattern recognition, and immediate feedback loops. Beginner intuition is built on fear, hope, recency, and ego. Those two things might feel the same internally, but they are not even close to the same functionally. And we know this isn't just theory because we have data. A lot of it, one of the most cited studies in behavioral finance, was done by Barber and Odeen, who analyzed tens of thousands of real brokerage accounts over multiple years. And what they found was brutal. The average individual investor underperformed the market by about 4% per year. Not because they picked terrible investments, but because of when they bought and sold. And it gets worse. The most active traders, the ones who trusted their instincts the most, underperformed by over 6% per year. Now pause for a second and really sit with that. 6% per year doesn't sound dramatic until you do the math. If you invest $10,000 and earn 8% annually for 30 years, you end up with a little over $100,000. That's compounding working for you. But if your returns drop to 4% because you keep making emotionally driven decisions, that same $10,000 turns into just over $32,000. That's not a small mistake. That's not, oh well, live and learn. That's your intuition quietly costing you 2/3 of your potential future wealth. And here's what most people don't realize. The problem isn't that intuition is always wrong. The problem is that intuition is confident at exactly the wrong times. It screams when the market is volatile. It whispers when patience is required. It feels strongest right before bad decisions and weakest right before good ones. And that's not an accident. That's psychology. Your brain is wired around loss aversion. Losses feel about twice as painful as equivalent gains, feel pleasurable. That means your gut is constantly trying to protect you from short-term pain, even if that protection creates long-term damage. So when you're up on a trade and you feel that urge to lock it in, that's not wisdom. That's your brain saying, please don't let this turn into regret. And when you're down and you don't want to sell, that's not conviction. That's your brain saying, please don't make this loss real. Let's make this concrete. Say you buy a stock at $100. You have a plan. You tell yourself you'll take profits at 130 and you'll cut losses at 90. That plan makes sense. It's logical. It's balanced. But then the stock goes to 108 and suddenly your gut wakes up. You start thinking about what that 8% gain could buy you. You imagine it disappearing. You imagine yourself feeling stupid for not selling. And so you do. You sell early. And in that moment, you feel relief. And that relief is dangerous. Because your brain just learned that selling early reduces discomfort. It doesn't care that you violated your plan. It cares that the anxiety stopped. Over time, this conditions you. You start taking small wins and avoiding small losses, even when the math says that letting winners run and cutting losers quickly is how you make money. And this is why so many people feel like they're right all the time, but still aren't profitable. They avoid pain so effectively that they avoid profit too. This is where it gets really interesting, because once you understand this, you start seeing it everywhere. Think about casinos. Imagine a game where you flip a coin. Heads, you win $2. Tails, you lose $1. Objectively, this is a great game. The expected value is positive. If you play it enough times, you will make money. But if you flip tails 3 times in a row, your gut will tell you the game is broken. It will tell you to stop. It will tell you you're being stupid. Even though the math hasn't changed at all, trading is that game, except the outcomes are spaced out over time and dressed up with narratives. Your intuition reacts to streaks. The market rewards expectancy, and those two things are constantly fighting each other inside your head. Now, you might be thinking, okay, but what about traders who say they just know when something feels right? And that's a fair question. But here's the distinction. Those traders are not reacting to raw emotion. They're reacting to patterns they've seen hundreds or thousands of times before. And even then, the best ones still use rules. They still manage risk. They still know that feeling right doesn't mean being right. Here's another uncomfortable truth. Most people don't actually want to be profitable. They want to feel smart. They want to feel in control. They want to feel like they outsmarted the market. And intuition gives you that feeling. It gives you a story. It lets you say, I knew it. But the market doesn't pay you for narratives. It pays you for consistency. This is why professional traders look so boring from the outside. They use systems. They use checklists. They size positions based on formulas, not vibes. They know that if they let intuition drive their decisions, they will eventually give back everything they make. So instead, they design processes that assume they will feel fear and greed, and they work around it. Let's talk about a simple math example, because this is where a lot of people have an oh wow moment. Imagine you have a strategy that wins 40% of the time. That doesn't sound great, right? That your average win is $500 and your average loss is $250. Over the long run, that strategy makes money. The expected value per trade is positive, but only if you actually follow it. If you start cutting winners early because they feel scary and letting losers run because you don't want to admit you're wrong, you destroy the entire edge. And the worst part is that it doesn't feel like sabotage. It feels like self-protection. So what do you do instead? The answer is not be stronger or control your emotions better. That advice is useless. You don't fight human nature. You work with it. You pre-commit. You decide in advance what you will do, and you remove as many in-the-moment decisions as possible. You reduce position size so emotions don't hijack your brain. You track whether you followed your plan, not whether you made money on a single trade. And when you feel a sudden urge to act, you pause. Because urgency is almost always emotional, not rational. Here's what most people don't realize. The goal isn't to eliminate intuition. The goal is to demote it. Your gut should not be the CEO of your trading decisions. It can be an advisor. It can raise flags. But it does not get the final say. That belongs to your system. And once you make that shift, something really interesting happens. You become calmer. You stop obsessing over every tick. You stop tying your self-worth to individual outcomes. And paradoxically, that's when performance improves, not because you became smarter overnight, but because you stopped getting in your own way. I've seen this play out again and again. Smart people, thoughtful people, people who genuinely want to do better. They're not failing because they don't understand charts or fundamentals. They're failing because they're human in a system that punishes emotional decision-making. And once you see that, once you stop blaming yourself and start designing around your psychology, everything changes. So if this video helped you see your own behavior a little more clearly, hit the thumbs up. It really does help get this kind of content in front of people who need it. Subscribe if you want more videos that break down the math and psychology behind better financial decisions. And remember this, the next time your gut starts screaming at you in a trade, it's not trying to make you rich, it's trying to make you comfortable. And those two goals are not the same.